Ready to review the key terms from Unit 5.5 in IB Business? Let's begin. What is the break-even point in business? The break-even point is the quantity where the firm's total cost will just equal its total revenue. What is the formula to calculate break-even quantity? Break-even quantity equals fixed costs divided by contribution per unit. This tells you how many units must be sold to cover all costs. What does a break-even chart show? A break-even chart is a graph that shows total cost and total revenue. The break-even point is where the two lines intersect. Why is break-even analysis useful for decision-making? It helps businesses predict when they'll start making a profit and assess the risk of new ventures or pricing strategies. What assumptions does break-even analysis rely on? Break-even assumes constant selling price, fixed costs, and variable cost per unit, conditions that may not reflect real-world changes. What are the limitations of break-even analysis? Break-even analysis may oversimplify reality, ignore economies of scale, or fail to account for changes in market demand. How can changes in costs or price affect the break-even point? If fixed or variable costs increase, or if the selling price decreases, the break-even point shifts higher, meaning more sales are needed to break even. What is a break-even margin and how is it used? The break-even margin is the difference between the selling price and break-even price. It shows how much buffer a business has before slipping into loss. What is meant by the margin of safety? The margin of safety is the amount by which the existing level of output is greater than the break-even point. How do you calculate contribution per unit? Contribution per unit is found by subtracting variable costs per unit from the selling price of a product. What does total contribution mean? Total contribution equals total revenue minus total variable costs. What is break-even revenue? Break-even revenue is the amount of revenue needed to cover both fixed and variable costs so that the business breaks even. What is included in overhead costs? Overhead refers to a broad category of fixed costs that includes interest, rent, taxes, and executive salaries. What are fixed costs in a business? Fixed costs are expenses that do not vary with the quantity of output produced. What are variable costs? Variable costs change depending on how much a business produces, they rise or fall with output. How is total revenue calculated? Total revenue is the price charged to customers multiplied by the number of units sold. How do you express the margin of safety as a percentage? The margin of safety percentage is calculated as margin of safety divided by break-even quantity times 100. What is a no-brainer in business decision-making? A no-brainer is a business decision so obvious it requires no contemplation. What does the term boondoggle mean in a business context? A boondoggle refers to wasting money or time on unnecessary or questionable projects. What does it mean if someone is being above board in business? Being above board means acting in an honest and open manner.